Welcome back to episode 3 of the infrastructure project finance video series. Today we're going to put in a quick MOIC metric, see what our cash on cash return is, and then we're going to get into some HoldCo analysis and some interest only analysis. So first thing, we need to understand what our net purchase is from an equity standpoint. So we're going to start with just putting in a quick header. And now we're going to go net purchase, our equity distributions. And it's essential we pick up our distributions from our distribution trap and not just the cash available to distribute. And then finally, we're going to have our MOIC. So our net purchase is just simply going to be our purchase price plus our total debt issuance. So what is our outlay of cash for our investment? Next, we're going to go look at our actual equity distributions, which we're picking up distribution line here, what passes the test here, and putting a quick negative on here. And then all we're going to do is just sum our total distributions over our net purchase. And what that's going to give us is our total MOIC. And we're going to put a max on here, but you can see your MOIC over time essentially. And we're going to go in and put in a sum here. And that way we can grab this and lock it. So if we have additional capital over time, that will be reflected in our MOIC. And we're going to put in a max formula here and pull in our number format quick. And there's our MOIC, pulling some of these metrics up so we can see what's going on over time. So what we're just going to do is we're going to put in what's driving what. Next, we're going to put in some titles here quickly. We're going to call this cash flows, and then we're going to call debt, and lastly we're going to call this equity down here, just to start to clean things up as we advance this model. Formatting is going to be important. We have our cash flows, and then we're just going to put in our simple little dividers. So we're going to call this OpCo. And then we're going to move into our HoldCo. So HoldCo CFADs uses the exact same CFADs as OpCo. It's just we constrain them a little bit differently. So first thing, if you're following along in this video, I've changed our distribution test to 110. So the reason I did that is we want to use a 115 consolidated DSCR. And what that's going to give us is just a little bit more capacity to go in and put incremental leverage on here. So we're going to start with linking our CFADs, and our CFADs is going to be the same line. Now we're going to put in our constrained CFADs, which is going to be our consolidated constrained CFADs. And here we're going to be using our 115 DSCR. Very similar logic. All you're going to do is take your CFADs and divide by your DSCR. That in, pull it across, simple as that. So this means that we have 930 million of consolidated debt service we're allowed to use. Now, this doesn't go straight to the HoldCo or get allocated to the HoldCo. We first have to back out our OpCo debt service, which is simply just going to be a link down below. So we're going to take a negative of our OpCo debt service. So our HoldCo constrained CFADs is just going to be the sum of these two. The sum of these two is going to be what we can allocate to our HoldCo debt. So next, what we're going to do is we're basically just going to duplicate our OpCo interest buildup. We're going to take all this and just duplicate it because that is much simpler than rebuilding it. So our fix over isn't going to change. We don't have control over the macro, but what is going to change is our spread over SOFR or our margin. And then our periodic interest rate, we're just going to use the same. We're going to use the same year frac, and now we have our periodic HoldCo interest rate. Next thing we need to do is pull in our discount factor. So for now, we're gonna use financial close again. That's gonna change for the OpCo as we'll put in interest only periods, but we're just going to link this to financial close, and there we have it. Now you'll see that these factors are slightly lower in each period because you're discounting heavier because your interest rate is higher. Then our debt size is simply going to be our discount factor times the sum product of our HoldCo constrained CFADs. And all of a sudden we have 76 million of available debt size. Great. So now we got to build in our actual tranche. So we're going to do the same thing over again. We're going to just copy the existing OpCo and we're going to put in HoldCo debt now. Our issuance is beautifully already linked up and we just need to tie this to financial close. Now we have an issuance, tie our amortization to our HoldCo constrained CFADs, and voila, we have a beautifully fully amortizing HoldCo debt in place with really not much incremental effort. So we're going to call this OpCo debt service, HoldCo debt service, and this is going to be our OpCo DSCR. And below this, we're going to put in our consolidated debt service. And the reason we care about consolidated debt service is quite often HoldCo issuances or financings are done on consolidated metric. There's instances where a HoldCo metric is used, but I think that's quite sponsor friendly. And personally, I don't think it encapsulates your full credit risk. We'll get into that in future videos. So our consolidated debt service is going to be our OpCo debt service plus our HoldCo debt service, which will get us our consolidated debt service. Simple as that. We're not really outputting a leverage metric or anything like that. We have our PLCR, and we're just going to call that an OpCo PLCR. PLCR is often used in rating agencies and can have HoldCo rated debt for sure. Definitely in the LNG world, in the transmission line world, anything with a rate base, but we're just going to avoid that for now. So what we need, and what will tell us if we did this correctly, is did we go in and calculate this properly by having a consolidated DSCR equal to our sizing DSCR. So our sizing DSCR is 115, and at a minimum, we should have a 115 DSCR. We're going to go check that out right now. So we're just going to take this formula to start. Most of it's correct, and we're just going to simply drag down this to consolidated DSCR. Our CFADs are going to be the exact same. And there we have our 115 DSCR. Okay, what's next is we're going to have to go and look at our cash available to distribute. This is now going to have to be off of consolidated debt service. So our cash available to distribute is now going to be off of consolidated debt service. And take a look at this number right here. Our IRR is going to drop initially. And that's just because we have less cash. That makes sense. All of a sudden, oh man, we have a 5% IRR. This means we got a cost of capital issue potentially. But hold on. We need to go in and change our debt issuance here. And this is really going to change the story for us. So we're going to go our OpCo debt issuance plus our HoldCo debt issuance. And what that's going to do is going to drive down our equity check, which we'll see if that's accretive to IRR and MOIC. So we go in and put the extra equity, and all of a sudden our IRR is massive and our MOIC's massive. Now, we don't know for sure if this would be financeable in the world. We'd have to go look at the credit risk. But from a structure standpoint, I've seen many financings with a consolidated DSCR of 115. And we changed our distribution test to 1-1, just because you basically can't distribute cash if you're at a 115 or you don't have much buffer. You'd have to hit a perfect operating track record to go and accomplish that based on how this debt is structured. Next, we're going to put in interest-only periods. What we need to do is build in a sizing period, our initial sizing period, and then we're going to adjust our amortization. Our sizing period is going to be a function of how long our interest-only period is. We're going to look at our operating period number, and that's going to tell us how long we've been operating for. So we're going to go this times this plus this. So this increases over time and is linked to when we start operating. Really simple formula. And then our initial sizing period greater than our interest only period. So here we're going to, in a sizing period, because we have 0 interest only periods, and that's what this variable is. And then we're going to go in and look at our initial sizing period, which is just going to equal this equals 0 and this equals 1. And what we need to check is it doesn't turn on here, because then we'll have a discounting issue. So what we're going to do is we're going to change our discount factor to, instead of being front-ended like this, we're going to do it in the same period to ensure the model stays dynamic. And the next thing we're going to do is we're going to look at our constrained CFADs from an OpCo standpoint and times these by our OpCo sizing period. So what that's going to do is when we go in and change this to 1 year, so we're going to lock this, ensure this is locked. Once our interest only period is lapsed, we start sizing. And now the discount factor is going to start in the exact period before that. And we're going to have our constrained cash flows turned off prior to that. And that's going to allow us to size appropriately so that this 567 and our amortization turns off until we're done our initial sizing period. So we have 4 quarters or a 1 year interest only period. Essentially, we now have the ability to put in interest only. Oftentimes, sponsors want to have front-ended yields or have a specific sizing period and specific metrics that they want to accomplish. And they'll go in and look at a rolling IRR over time to go and see how that's impacted. So X IRR and values, and our dates are going to be same range, just our actual dates. That's going to be at 6. So we're just going to put an if error in there. And now we have a rolling IRR. And the way to test this is if your end period IRR equals your total IRR. And we're just going to, so that you can see what IRR you're accomplishing at what period in time. So we get to our 9.27. And essentially our interest only period allows us to see what kind of timing impact this has. So if we went and looked at closing here and we went and looked at, let's say 28 periods or 7 years, and we went and pulled this up at the end of our holding period, does an interest only period improve that? So if we turn this back to 0, it doesn't. And it definitely doesn't if we go 5 years, let's say your entire holding period. And the reason that is, and you can see IRR goes down as well, is because we have less of a sizing period, we have less of a time to go and amortize the debt. So our OpCo debt size goes down quite a bit. That enables our HoldCo debt size to go up, but that's not really accretive because you have a higher cost of debt here. So generally, interest-only periods don't typically impact returns or IRR in a accretive way that I've seen, but I've seen a lot of sponsors request them. So it's something that I think it's important to understand how to model and how to put in features and increase the value of different tranches of debt. This often comes up when you're running a TLB or a different product above where you want cash flows coming up. And let's say you have a ramp period or something like that. So you want to be able to distribute more cash to the top of the house to go in and optimize your total debt stack. So it's something I wanted to cover today, a little bit nuanced on how we model it typically, and I will look forward to seeing you in the next video. If you enjoyed the content today, please like and subscribe, and feel free to send some comments my way or an email of what you'd like to see next. I got litany of videos planned, but love to hear your thoughts. All the best.